That moment when you close a winning trade too early haunts you more than any losing trade ever will. You had British pound perfectly positioned for a 200 pip move. You caught the breakout. Your analysis was flawless. But when you hit 30 pips of profit, some invisible force made you close the position. You watched from the sidelines as price continued exactly where you predicted, leaving 170 pips on the table. The next trade, you held a loser for 3 days hoping it would come back. Same brain, opposite behavior. This isn't random. There's a psychological mechanism running your trading decisions that has nothing to do with market analysis and everything to do with how your mind processes success and failure. What I'm about to reveal will explain why you consistently do the opposite of what profitable trading requires. The right addiction that's bankrupting you. Your brain treats every trade like a public exam where being wrong means you're stupid. When price moves against your position, your unconscious mind doesn't register, market moved in unexpected direction. It registers, I failed the test. This psychological framework transforms trading from probability management into ego protection. You'll hold a losing trade for hours watching it bleed your account, because closing it feels like admitting you don't understand markets. Your need to be validated by price action becomes more important than protecting your capital. The addiction to being right explains why most traders can't cut losses quickly. It's not about the money, it's about what the loss represents to your self-image. A 100 loss feels manageable, but a 100 admission that your market analysis was wrong feels devastating. Your ego convinces you that if you hold the position long enough, price will eventually prove you were right all along. Meanwhile, your 100 loss becomes $500, then $1,000, then a margin call. You're not managing risk, you're managing your reputation with yourself. This need for validation shows up in how you talk about trades after they close. When you're right, you'll replay the analysis that led to the win, reinforcing your identity as someone who gets it. When you're wrong, you'll focus on external factors that caused the loss. The news moved the market. Stop hunters triggered my exit. Algorithms manipulated price. You're unconsciously protecting your ego by refusing to accept that your analysis was simply incorrect. This mental framework prevents you from learning because you can't improve at something you refuse to take responsibility for. The right addiction also affects your position sizing in subtle but destructive ways. When you're confident about a trade setup, you risk more money because being right on a sure thing feels better than being right on a small position. When you're uncertain, you risk tiny amounts because being wrong on a large position would hurt your ego more than your account. Your position sizing becomes based on how right you want to feel rather than what the probability and your account can handle. You're optimizing for emotional satisfaction instead of mathematical expectation. Your analysis paralysis stems from the same psychological root. If you study the setup long enough, you can convince yourself that you've found enough confirmation to guarantee success. The more time you spend analyzing, the more right you'll feel about the trade, and the more devastating it will be if you're wrong. So you keep looking for additional confirmations that don't actually improve your edge, but make you feel more intelligent about your decision. You're not seeking better trades, you're seeking more reasons to feel smart about the trades you're already planning to take. But here's where this addiction becomes truly dangerous: the certainty delusion. Professional traders understand that uncertainty is the only certainty in markets, but amateur traders are constantly seeking predictions disguised as analysis. You'll watch YouTube videos titled "Euro-Dollar going to 120" because you want someone to tell you what will happen rather than how to manage what might happen. This certainty-seeking behavior turns you into a consumer of market predictions instead of a manager of market probabilities. You're looking for guarantees in a business where the only guarantee is that no one knows what happens next. The delusion of certainty makes you confuse correlation with causation in your market analysis. When you see a pattern that worked 3 times in a row, your brain assumes it will work the 4th time. When a support level holds twice, you assume it will hold forever. When your strategy has 5 winning trades, you assume you've figured out the market. This psychological bias causes you to increase position sizes and reduce risk management exactly when you should be most cautious about overconfidence. Certainty addiction also explains why you keep switching strategies after a few losing trades. When your current approach stops working, instead of accepting that all strategies have losing periods, you assume the strategy is broken and start looking for a new one. You're not seeking better edge, You're seeking the psychological comfort of feeling certain again. Every new strategy represents a fresh opportunity to feel smart and right about the markets, but the cycle repeats when reality proves that no approach works all the time. The most dangerous manifestation of certainty delusion is how it affects your trade management. Once you're in a position, you become emotionally invested in your prediction being correct. Instead of managing the trade based on what price is actually doing, you manage it based on what you want price to do. You'll ignore obvious exit signals because accepting them means accepting that your prediction was wrong. You'll hold past your target because you're certain the move will continue. You're trading your beliefs about the future instead of reacting to present market information. Your relationship with stop losses reveals the depth of your certainty addiction. If you were truly comfortable with uncertainty, stops would feel like insurance policies, necessary but unremarkable. Instead, they feel like admissions of failure because they represent your backup plan for being wrong. Many traders set stops so far away that they're meaningless, or move them further when price approaches. Because the psychological act of being stopped out feels like public humiliation. You're not protecting capital, you're protecting ego. Once you understand how this delusion works, you can start building something more powerful, the probability mindset. Elite traders think in probabilities, not predictions. When they enter a trade, they're not betting on what will happen. They're betting on what's most likely to happen, while preparing for what else could happen. This psychological shift from certainty to probability management changes everything about how you approach markets. Instead of needing to be right, you need to be profitable over many trades. Instead of avoiding uncertainty, you learn to profit from it by positioning yourself on the right side of probability distributions. Probability thinking changes how you handle losing trades completely. When you truly accept that even good setups fail 40–50% of the time, individual losses stop feeling personal. A losing trade doesn't mean you were wrong about your analysis, it means you experienced the expected outcome in a probabilistic system. Your job isn't to avoid losses, it's to ensure that your wins are larger than your losses over time. This mental framework makes cutting losses quick and emotionless because you're not protecting your ego anymore. The probability mindset also transforms how you view winning streaks and losing streaks. Instead of feeling like a genius during wins or an idiot during losses, you understand both as natural fluctuations in a probabilistic business. You'll stop increasing position sizes during winning streaks because you know they don't predict future performance. You'll stop decreasing position sizes during losing streaks because you know they don't indicate that your edge has disappeared. Your emotional state becomes decoupled from short-term results. Position sizing becomes mathematical rather than emotional when you think in probabilities. Instead of risking more when you're confident and less when you're uncertain, you risk the same percentage on every trade because you understand that your confidence has no correlation with actual outcomes. You'll risk 1–2% per trade regardless of how good the setup looks because you know that your ability to distinguish between good and great setups is largely illusion. Consistency in risk management becomes more important than trying to optimize for individual trades. The ultimate psychological shift happens when you realize that being wrong frequently is not just acceptable, it's necessary for long-term profitability. Professional traders expect to be wrong 40–60% of the time and design their systems accordingly. They're not trying to increase their win rate to 80% or 90% because they understand that higher win rates usually come with lower reward to risk ratios. They're optimizing for positive expectancy over time, not for the psychological satisfaction of being right on individual trades.